What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone, brought to you by the Pulis Group. There is a section of the IRS code that allows for the tax-free gain on the sale of certain stocks. That area of the tax code is the center of today's podcast episode, Section 1202. So Section 1202 says taxpayers, other than corporations, are eligible to exclude gains on the sale of shares of qualified small business stock. Now, the amount of the gain that's tax-free depends on the year the stock is acquired by the taxpayer. So if it's acquired after September 27th, 2010, the exclusion is 100%. There's some limitations. We'll talk about those shortly. If the stock was acquired after February 17th, 2009 and before September 28th, 2010, the exclusion 75%, so short time frame in there. And then for stock acquired after August 10th, 1993 and before February 18th, 2009, the exclusion is 50%. And there was no such thing as an exclusion. Section 1202 didn't come into play until August 10th, 1993. So that's the very earliest this would apply. Now, there's various tests that must be met by both the taxpayer and the corporation issuing the shares of the qualified small business stock. So what is qualified small business stock? Qualified small business stock is stock that was originally issued by a qualified small business after August 18th, 1993. There are 7 tests to qualify as small business stock, as qualified small business stock. So the first, it has to be C corporation stock. So you're getting shares of a C corporation. The original issue of the stock must have been after August 18th, 1993. The issuing C corporation must have total gross assets of $50 million or less. So this is for smaller companies. $50 million, pretty decent sized company, but in the grand scheme of things, especially when you consider publicly traded companies, we're talking about small corporations. You must purchase the stock at its original issue. So it's only applicable to original issue stock. The issuing corporation must be an active business. So not an investment company, let's say. It's an active business. The corporation can't have bought its stock from you or a related party in a buyback during the 4-year period starting 2 years before the original issue date. So basically, these corporate redemptions of stock can throw a wrench into things. And the corporation cannot have bought back its stock from anyone during the 2-year period starting 1 year before the issue date. So the last 2 points are dealing with redemptions and corporate stock buybacks. So be careful there if you're going to look at this. Better not to have that at all. Now, a corporation is considered an active business for purposes of the number 5 that we just discussed above, as long as 80% or more of its assets are used in the active conduct of a qualified trader business. So qualified trader business is any business that's involved it's any business that's not involved in certain areas. So the business cannot be involved in the fields of health, law, engineering, architecture, accounting, actuarial services, performing arts, consulting, athletics, financial services, brokerage services. So basically those professional service fields. We talked about the qualified business income deduction not too long ago. Similar case there with a few exceptions. The qualified business income deduction did not exclude engineering or architecture. They are excluded here under 1202. The business also, it excludes businesses that the principal assets, the reputation or skill of one or more of its employees. Banking, insurance, financing, leasing, all of those are excluded. Farming business and any business that's operating a hotel, motel, restaurant, so real estate businesses or businesses involved in the production or extraction of minerals. These are all excluded businesses. Outside of that, generally the business will qualify as long as it's a C corporation, meets all the above tests that we just discussed. Now, the gain exclusion itself allows you to exclude gain from the sale of qualified small business stock if you've held it for more than 5 years. Then your gain exclusion could be $10 million, $5 million if you're married filing separate, or 10 times your aggregate basis in the shares of the issuing stock. So it could go higher than 10 million if your basis is high enough. So 10 times your basis. If you have a basis in the stock of $1.5 million, you can go with the 10 times your basis in the shares for the exclusion rather than 10 million. Quite a lot of gain exclusion available here. Now, the taxpayer that is excluding the gain, because this is the gain exclusion taken on your personal return, the taxpayer must have owned the stock for at least 5 years. So you've owned it for 5 years. Must be an original shareholder. So you can't purchase the shares from another individual or on a secondary market. And you have to acquire the shares directly through an underwriter, directly from the corporation or through an underwriter in exchange for money or property or as compensation for services. So services provided to the corporation. You do not have to own the stock directly to benefit from the qualified small business stock rules. So non-recognition of gain is possible if you hold your shares through a partnership or an S corporation or a trust, as long as they meet all of the other eligibility requirements are met and the stock qualifies as qualified small business stock. Then you can still exclude gain owning it through a partnership. So the partnership would own the shares, let's say. Same applies to S corporation and trust. Now, the entity that holds a qualifying stock, so let's just say you own your stock through a partnership interest, the entity has to hold for more than 5 years, and you had to own an interest in the partnership at the time the qualified small business stock was acquired and at all times after that. Okay, so you still have to pass all these tests. Just rather than owning it individually in your own name, you could own it through some other pass-through entity. Now, how do you report this on your tax return? So you report the sale of 1202 stock on Form 8949. So this is the form for sales and other dispositions of capital assets. It's the same as you would report the sale of any other stock. But what you do to indicate it's Section 1202 stock eligible for the gain, you use code Q in column F to let the IRS know, hey, this is 1202 stock, we're excluding the gain, and you'll enter the gain that's being excluded as a negative number in column G. Now, generally, C corporations are avoided by small companies due to double taxation. However, if you're in an industry that's eligible for Section 1202, so that's anything that's not, basically any industry that is not involved in professional services like health, law, engineering, accounting, banking, and is not real estate, then as long as the entity structure itself is a C corporation, it can qualify as qualified small business stock. As I was saying, many smaller companies avoid the C corporation because of the double taxation. However, if you can qualify, this is a great opportunity when you're choosing your entity type to have a discussion and sit down with your CPA for some tax planning. Because if you can qualify for this and you have a strategy that maybe you're going to start this business, get it up and running, and your plan is to sell it in 5, 6, 10 years, whatever that may be, you can have a tax-free gain on that sale if you meet all the qualifications. So it's good to know. Good to know that going into it. So that about does it for today in our discussion of Section 1202. If you found value in this episode, please leave us a 5-star review or hit that like and subscribe button. Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.